In today's video, I will show you some interesting facts about how much money large traders need to move the markets and create the manipulation maneuvers that we often talk about here in this channel. First of all, I'm assuming you understand a little bit about how supply and demand works and how markets rise when people buy and how they fall when people sell. I'm not going to get into that today, so I'm assuming you understand how that works. I thought it would be a good idea to pick an extreme example of a giant market like the euro dollar. So, in every pip of the euro dollar, you have about $100 to $200 million of depth. That means that if the market moves 10 pips up, about $1 billion were bought in excess of what was sold. These numbers are not fixed, of course. They vary according to the market level based on what most traders do. Remember that there are levels in price where most of the market puts stop-loss orders, so in those levels the liquidity pool is deeper. The first interesting fact here is that a pip is the fourth decimal case in an exchange rate, and cents are in the second decimal place of an exchange rate. That means if you wanted to move the exchange rate of the euro dollar by 1 cent, you would have to move the market by 100 pips. If you do a quick calculation, you would need $100 to $200 million for every pip times 100. So you would need $10 to $20 billion to move the exchange rate of the euro dollar by 1 cent. Just stop to think about how much money that is. Alright, but market makers are not really interested in moving the exchange rates in that level. That's just a curiosity. They want to tilt the market in specific points. So let's take a real example here. In this chart, we have the euro dollar in the daily time frame, which is a giant market with tons of liquidity and also one of the deepest markets today. If you want to be a market maker in this particular setting, you will need several billions of dollars, and I'll get to that later on because there aren't too many individuals with that kind of money. Right, so from the other videos and from the market maker course, you already know that market makers first induce the market to one direction with the sole purpose of moving the market to the opposite direction at a specific point. The way they do that is by nudging price just enough to trigger a movement to a specific direction. For example, in this price vector going up, we can see that every single candle has a higher low. That means that the market makers here are buying near those lows to not let the pattern break and make it look like the market is indeed going to skyrocket. The important detail here is that every time price is in a low, they will buy a certain amount, just enough to nudge the price to the upside. In the daily euro dollar, that might represent something like 10 or 15 pips in each of those candles going up. We have 9 candles there, so that already represents 90 to 135 pips. And that represents something around $9 and $27 billion. It's hard to tell exactly, but it's something between those numbers. Just as a reminder, if you want to have a $20 billion position in the market, you will need much more than that because you need a margin for your positions to fluctuate. Remember also that each position on the way up is profitable. Let's just assume for simplicity's sake that in each of those 9 candles, the market makers covered 10 pips and that each pip represents $100 million. That means that in each candle, they have to buy 10,000 lots, which gives $100,000 per pip of profit. If you sum the pip distance between each candle low up to the black line, which is the moment where the market makers will unload all of that at the expense of retail traders, you will get around 1,200 pips. So 1,200 pips at $100,000 per pip will give you $120 million of profit on that vector up. Right, so the problem is that this position is too big and market makers cannot simply close without disrupting the market. So they need a deep liquidity pool that will be provided by that high marked by the black line. I won't go into much detail here. That's where the retail traders are putting their buy stop orders, thinking this market will shoot up like a rocket. All of that means that there is a deep liquidity pool in terms of demand there, which is perfect for market makers because that means they can unload their massive position all at once. And even better, they can create a position to the downside and profit once again. So when the market hits that black line, market makers start to unload their $9 billion position and they must sell enough now to create that significant inside candle that the market will interpret as a frustrated attempt to the upside. That's about 50 pips. So they would need to sell about $5 billion plus the $9 billion they already had. When the market realizes that price will not go up, the rest of the market starts to sell, and that pushes the new market maker short position into profit territory. As you can see, this is a very dangerous game and also a highly profitable one. In a matter of a month, the market makers in here could be facing a profit of around $250 million if we are being modest about the liquidity. It could very well be $500 million following the usual liquidity of the euro-dollar. You might be asking yourself, who the hell has that kind of money to play around in the daily euro as if it was a children's playground? When we're talking about this level of liquidity, it's very hard for just one individual to do this, because to have a $10 or $20 billion position unleveraged like that, you would need to have something like $500 billion to be safe. So we're not talking about an individual's wealth in this level, but we are talking about a fund. The largest funds in the world are the sovereign wealth funds, who might be run by an individual, but they are funds of entire countries. That's probably the only way in which you can have more than $500 billion at your disposal to play around in the market. If you do a quick search, you'll see that the three largest sovereign wealth funds in the world are from Norway, China, and the United Arab Emirates. The Norway fund has over $1 trillion, so those managers do have the power to manipulate the euro if they want to. Very ironically, China, with its meta-capitalist approach of existence, has the second largest sovereign wealth fund in the world. Just imagine a Chinese fund extracting billions of dollars out of the euro-dollar exchange rate. The United Arab Emirates, with its oil money, also has tremendous power to manipulate pretty much any financial instrument in the world. So there you have it. That's what it takes to actually be a market maker. Of course, if you're dealing with a smaller time frame in a shallower market, you need way less power than that. But we're still talking about millions of dollars. This is very interesting stuff, and I intend to make some seminars in the future dissecting exactly a few of these market manipulations. So if you want to learn how you can stop being maneuvered like sheep in the market and how to actually profit from these deceptive tactics, check out the Market Maker Strategy video course I created in the link in the video description. You can also learn about this in the new Price Action course Volume 1, which deals with a whole array of techniques and theories that take this sort of thing into account. So if you liked the video, please support the channel by clicking the like button, subscribe to the channel, and leave your comment below. Thank you very much for watching, and have a nice weekend. Take care.